Hello everyone, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video on Canadian National Railway Co., ticker symbol CNI. This video was suggested through a comment by Guy L. Morin 2985, where he's commented, a video about Canadian National Railroad would be great. It's currently down due to trade tensions. It's a great buy right now. And I think that it would be a great video to kind of look at this specific railroad company because obviously there's a lot of tariff talk and trade tensions with Canada right now. And I think it'd be interesting to see the effects that that has on a logistics type of company like this that probably imports and exports a lot of different things across that border. I really like railroad companies fundamentally because I feel like they're an easier business to kind of get a valuation for and to understand, simply because there's not a lot to it as much as there is you're moving things from one place to another using a railroad, obviously. I also really like railroads because they're very inflation proof. So once you pay for your rail cars, that's the price that you're paying for them. Obviously, you are paying debt for certain assets over time, and it does take a lot of capital to kind of get into this business. It's not a very competitive business, meaning that there aren't a lot of people trying to enter in, despite the fact that they are making money still. And it is a viable option for moving things across the country in large quantities and uninterrupted in a lot of ways, right? So I do think that railroad companies are very attractive for that reason, but they don't always have the same amount of growth and they aren't as interesting as other companies, so there really isn't a lot of coverage on them. Now, this is a specifically very unique kind of situation because this is obviously the Canadian National Railway Company. So there is a lot of tariff talk and things like that that might be hurting this business. So I thought it would be interesting to kind of go through, do a DCF model valuation on the company and kind of give my thoughts on whether I think this is a buy, sell, hold, or just what my opinion is on the business as a whole. Looking at the stock, we can see that it is down 23.95% over the past year as of recording. It has a market cap of $62.31 billion, a price to earnings ratio of 20.2, and an annual dividend yield of 2.49%. So it does have a pretty good dividend yield there. We can see that the 52-week low is 93.64, so it's trading near that 52-week low, and the 52-week high for the company is 132.73. And now looking at analyst recommendations, they're kind of split between strong buy, and hold, with some rating an underperform or a sell. The current analyst price targets range anywhere between 104.72 and 127.42, with an average analyst price target of 115.95. So there is some different opinions on where the stock should be. And obviously the tariffs are hurting this a lot in the short term, and we could see that from the past performance. I mean, it's not normal for a stock to sink 23.95%. So I think that this might have been a really just black swan event that has hurt the stock. And if you believe that the tariffs are going to continue, I don't think that this is a buy specifically for that reason. So there's some risk with that and some unpredictability with this administration on what they're going to do with the tariffs moving forward. If you think that they're just a negotiation tactic and they're not fully going to go into place, or they're not going to be as extreme as what analysts are forecasting, I think that this stock is a buy. But really, I think everything kind of pins on what's going to happen with the tariffs. But if you're a long-term investor who believes that the tariffs may be worse than what they're thinking, and in the long term, the tariffs are going to go away, I think that this probably would be a buy, but you'd have to stick in for the long term on this one. Looking at our weighted average cost of capital, I've calculated a weighted average cost of capital of 5.28%, with a cost of debt after tax of 3.169% and a cost of equity at 6.011%. I do like that they only have 25.78% of their total weighting in debt compared to their market cap or equity weighting of 74.22%, especially with the drop in the valuation. Now, this is telling me that their debt is very manageable compared to a lot of other businesses, and this makes sense because they are more of a mature company. Railroads typically do have some debt, and it does make sense because, as we can see here, their cost of debt is pretty much half of what their cost of equity is, and that does pull down our weighted average cost of capital to that 5.28%, which we will use as the discount rate. So I think that that's a green flag for sure when you see the debt that low. And if we move on to the model, we can see that even with a negative 1% growth rate in the free cash flow on average over the next 9 years, and keep in mind, this free cash flow has been lower than pretty much any of the other full year free cash flows, and it has been dropping pretty significantly every year. We can see that the stock is undervalued for what it's currently trading at. However, this is a little bit misleading because we can see that the average revenue growth per year is up 5.94%. So I believe that they're either doing something like paying off more debt or buying back more stock. But despite that, the future valuation is based off of future free cash flows. I do want to say, too, that I was kind of thinking about this, and with the tariffs and everything going on, I don't think that this stock is good for someone who wants to see a lot of growth, because obviously railroads aren't going to be able to dramatically increase their revenue in a super meaningful way like a lot of other companies. They can optimize, and this one's in a really bad position right now, so it might be a great value play. It might not if the tariffs get worse. But I do think that this investment would be more suited for someone who just wants the dividend income from a very stable company. So if that's you, if you're around retirement age and you want a company that has very steady, good retirement income, I think that this stock is more suited for you because it's not in a situation where it's going to fluctuate a lot. I think that, again, this is a black swan event that's going to affect them. And I do actually think that it's probably more likely that it is undervalued than it is overvalued. But it also is likely that it could drop more and you could get an even better deal in the short term. But I think long term, this stock will eventually come back, but there's not going to be a lot of future growth going forward. And for me personally, I don't even want to be involved on what this administration's deciding. I want stocks that are going to consistently increase no matter what. So for me, I don't think I would personally want to add this to my portfolio. But if you're someone who wants good dividends and you believe that the tariffs are going to be dropped and aren't going to be as serious as an issue or a concern as what a lot of analysts are thinking and a lot of other people are thinking, then I think that this could potentially be a very good buy, especially when you consider the fact that if they're able to grow the free cash flows just 3% a year, then there's 53.15% upside. And if we compute the average revenue growth amount on average per year, then this stock is worth double what it's trading for now. Now, I don't think that this is personally realistic, just because, again, the tariffs, I think, are going to hurt some of the next couple of years of cash flow. But again, if you believe that they're not going to be a serious hindrance going into the future, I think that this is a buy. But if you believe that they are going to really hurt this company and become worse, then I think that this is definitely not a buy, obviously. And if you're unsure, kind of like me, I really don't have an answer either way on whether it's going to be worse or whether it's going to be better. I think it's best not to put a bet in on either side without significant research and understanding of the situation. And otherwise, I think that this would be a lot easier to evaluate, but for those kind of concerns, I think that it's kind of outside my wheelhouse, and I think that it's outside of most people's wheelhouse. So I do think long term, even if the tariffs take effect, this will eventually come back and have good growth and have good numbers. But I don't think that I would want to bet on this specifically, especially when I have the thesis that tech stocks are being undervalued currently after their massive drop-off. So I think that the opportunity cost would actually prevent me from wanting to get into Canadian National Railway Co. compared to something like Salesforce that I've been putting more money into, or Amazon, just for that specific reason. And I have a portfolio built more for actual growth and continual growth because I'm trying to grow the amount. But if I had a much more mature outlook in terms of, shorter term, just passive income, then I think that this could definitely be something worth a lot of consideration and a lot of thought. But this just doesn't fit my life circumstances, so I would not want to buy it. And I do also want to say that I'm not a financial advisor, and none of this is financial advice. But I think that this is a very interesting sort of company with the political climate right now and with everything that's happening. And I think that if you could make a smart, logical bet, you could make a lot of money, but it needs to be based off of the tariffs. Because if you believe the tariffs are going to be worse, then I think that you should wait and then buy this when it drops even lower. But if you think that they're going to get better, then I think that this very well is probably a buy. But those are kind of just my opinions on this stock. I think it's a very interesting company. I really like railroad companies. I want to add one, but I want to get in at the right price at the right time, specifically when I believe tech stocks have gone up pretty considerably and I'm able to trim some positions and get into something more defensive again. I don't think that that's the time for me right now, and I'm really happy with the tech stocks that I'm in. I also think that this company is subject to a lot of things outside of its control, and I personally just don't like to be in companies that have had that happen. But I also recognize the fact that something like this is very unlikely to happen again in the next 20 to 30 years. So the company's been hit with a really irregular kind of event. So that could be the perfect time to buy in if you believe that it's oversold. Let me know what you guys think of this analysis. If you liked it, if you didn't like it, please leave a like, dislike, comment down below. Please hit the subscribe button if you've made it this far. I really appreciate all of the support I've gotten on the channel. Thank you so much for watching.